I'm going to show you my secret formula that I use to make consistent profits every week, month, and year in the market. Okay, and the secret is very simply win rate. You need to have a very high win rate, and that's exactly what I'm going to show you how to do, because if you're winning most of the time, you don't have many losers that you need to worry about, and as long as your wins are more than covering your losses, you will make money over the long run, and your P&L curve is going to be very smooth. So the first thing you want to do is open up a list of things to trade, i.e. your watch list. Have IV rank on your watch list, order everything from high to low IV rank. You kind of want to filter out everything that has earnings over the next 45 days or so, and you want to get rid of anything that's low on the liquidity rating level, because we don't want earnings to disrupt our trade, and we don't want to be looking at anything to trade that's not very liquid, because it's going to be expensive to get in and out of. So once you've done that, you'll be left with something that looks like this. We don't actually care what's on the list, just as long as it hits those metrics, that criteria. You can have your own custom watch list. It doesn't really matter. We're going to have a look at GDX in this instance because it has a nice and high IV rank. It's a small to mid-sized ish underlying that's trading at about $45 a share. You only want to look at things to trade that have an IV rank of at least 30. Anything under 30 is no good to us. GDX has 48 in this instance and an absolute IV level of 32%. So once you've selected your underlying, you want to then pull up a list of option expiration dates for that underlying, because we are going to be writing options contracts, okay? And you want to pick an expiration date that is between 30 and 60 days. So as you can see here, 46 days, which is almost perfect. May 16th, we're going to open that up, and now we've got our calls on the left, puts on the right. We have this orange horizontal line that shows us where the price of GDX is with respect to these strikes going down the middle here. We have our expected move. This is what the market expects GDX to move between. This is the range that it expects it to move between. As you can see here with this vertical orange bar, it's also shown in parentheses here in the top right, plus or minus 3.67. And we're going to keep things very simple, and we're just going to sell one call and one put, very, very simply. Now, when you are let's just go one step back. So when you are buying an options contract, okay, you want price to move in that direction. Okay, when you are selling an options contract, you're doing the opposite. So let me just show you the significance of why we sell as opposed to buy. This is just one of the reasons. So let's say in this instance, you thought that GDX was going to go higher. Okay, let's say you think that GDX is going to go to $60. You might buy a 48 strike contract here for $1.26. You might buy this, and in this instance, you need price to move up. Price is currently below 48. If price goes lower, you lose. If price stays where it is, you lose. If price goes higher but not high enough, you lose. So you really only have one win condition, and that is for price to go above 49 or above 49.26 to be exact. And the reason why is because obviously you're buying, the strike is 48, but you're paying $1.26, so you're down $1.26. So you need to make up for that $1.26. So it's 48 plus $1.26. Above there is where you'd actually be starting to make money. Okay, so 49.26. Now, because you only have one win condition here, and price needs to do something, otherwise you lose. You're going to have a very low win rate, and you can see that here in the bottom left. So you got your pop, which is probability of profit. It's currently showing 25%. So you got a 25% chance of making money on this trade. Now, what happens if we were to sell this instead of buy it? So if we were to flip this, now our pop is 74%, because look at our win conditions, right? If price goes lower, we win. If price stays higher, if price is where it is, we win. If price goes higher but not too high, we win. We only really lose if price goes above 49.22 or 0.24, because that's what we would be collecting here. Okay, so when you're long a contract, you pay the premium. When you're short a contract, you collect the premium, and that's non-refundable. So in the instance of going long, you're at a disadvantage. You need price to do so much, and then even if it goes over your strike, it needs to go even higher because you paid $1.26. When you're short a contract, as you can see here, if price goes above 48, you're actually okay. As long as it doesn't go above 49.24, that's where you'll start to lose money. So this gray area here is your break even, or not your break even, but between the edge of this green bar and the edge of this gray bar, this is where you are going to be going. You're going to progressively be making less and less money as you get further and further down this grey bar, all the way up until this red bit, which is where you then start losing money. So now that we've identified why shorting contracts or selling contracts is better, and we know what needs to happen, we need price to stay away from our contract. If we want a high probability of success and we know what the expected move is, we simply just need to sell contracts outside of the expected move. Now, I like to be between 15 and 20 deltas. So as you can see, we've got delta on our setup here on our options chain with our delta columns. So let's just go with a 19 delta on the call side, as you can see here at the 51 strike. And then we can do the same thing. There isn't a 19 delta on the put side, so we'll go with the 21. The next one down is 16. So we'll go with the 21. And as you can see, our contracts are sitting basically at the edge or outside of the expected move here. This green bar shows us that if the price of GDX is anywhere along this green bar at the point of expiration, we're going to make money, okay? And as you can see, the green bar is longer than the orange bar, and this is going to lead to a high probability of profit. As you can see here, 70%. This is if you hold till expiration. However, the real key here is to get out early, and you want to get out at 50% of max profit. You don't want to hold till expiration, and if you do get out at your P50, you got an 82% chance of success. Now it's gone up to 84, okay? So you're looking at an 84% chance of success, which means you're going to be winning almost every single time. Now, in this instance, you would collect $120 up front, and your broker is going to require $545 in buying power to open this trade. So as you can see, we are getting a healthy return on our capital. This is in 46 days, and we've got an over 80% chance of success here, okay? Now, this is basically what you want to do. You want to do this again and again and again, have as many currencies as possible, keep your position sizes small. We are trying to operate like a casino or an insurance company. We're selling premiums. Every now and again, one might go against us, but we want to just stack as many wins as possible. There are some more advanced things that you can do. For example, if price, say for example, just dropped all the way down to 40, right, we're going to be in a losing situation. Well, we don't have to just take a loss. We can do some more advanced stuff like rolling, and we can roll, say for example, our call side down, collect more premium, and as you can see, what's happening with our break-even bar is moving. So even in a worst case scenario, i.e. in the 1 or 2 trades that you might lose out of 10, even those you can work back to a break even or even a small profit. So there's lots and lots of things that you can do here, and you do need to keep your buying power in check, and the way that you do that is by managing your position sizes. And to do that, we've created a free position sizing template. The link is in the description. The way it works is you enter the size of your portfolio. Say if it was $25,000, you enter that, and then you enter in the VIX level. Say if it was 21.9, and everything's going to be dynamically calculated for you. As you can see here, it tells you exactly what you need to be doing, or it tells you the maximum amounts that you need to be allocating. So in this instance, this is an example of an undefined risk position. So with this portfolio, we go to the undefined section here, and the maximum amount you would want to allocate is $1,750 to a position. Of course, here our buying power requirement is only 543, so this position would be absolutely fine in this example portfolio. Now, if you would like to learn in more detail about what you want about what we do and how we do it, the link will be in the description. This time click on EDS Premium, get yourself signed up. You will have access to this portfolio that I showed you an example of in this video, where you'll be able to see all of our trades, all of our adjustments, all of our rolls, etc. You can use that information to reverse engineer and study, or you can simply copy us. It's up to you. There's also a full course, so no prior knowledge is required. We will teach you everything you need to know. And if you get stuck, it's a private community, so you can speak with myself directly or with other like-minded individuals. There's a 100% money-back guarantee as well. So once you've been through the course and followed some of our trades, if after 6 months you're not profitable, we'll work with you for free until you are, or you can request a full refund. So it is completely risk-free. It's $9.99 a month to join. The price will be increasing, but once you're in, it's locked in for you for life. So you are rewarded for getting in early. The aim of EDS Premium is to teach you the skill. We don't want to keep you dependent on us. We want to give you the skill. Once you've learned it, no one can take it from you, and we aim to get you to that point within 6 to 12 months where you should be completely self-sufficient. So with that being said, I will see you guys on the inside.